Good morning, good afternoon, good evening, everyone. Thank you for joining us and welcome to the second webinar in the series discussing the requirements of IFRS 18, presentation and disclosure in financial statements. So IFRS 18 was published on 9 April 2024 and is the new IFRS accounting standard arising from the ISB's work on the Primary Financial Statements project. My name is Rowan Hasegawa. I'm a member of the IASB technical staff and project lead of the Primary Financial Statements project. IFRS 18 is the result of the work of a super team who you will mostly get to meet during our webinars. Today, I'm joined by Nick Barlow and Deborah Bailey. Hi, Nick.
Hello.
Hi, Deborah.
Hello.
Before we get started, let me go through a couple of general points. The first is that IFRS 18 and its accompanying materials are available on ifrs.org. Today's webinar is focused on management-defined performance measures. We invite you to submit questions relating to management-defined performance measures at any time during this webinar. We will try to answer as many questions as we can as we get to the end of the presentation, and we encourage you to submit your questions as soon as you have them, as this will increase the chances of us having time to answer them. And finally, just to note that the views expressed in this webinar are those of the presenters and not necessarily of the IASB or the IFRS Foundation. As mentioned, this is the second in the series of webinars introducing IFRS 18. Listeners that joined the first webinar will be familiar with this slide, but as a refresher for those who were not able to join the first webinar, we will start with a brief overview. So IFRS 18 is the new IFRS accounting standard that replaces IAS 1, so presentation of financial statements. And although some of the requirements in IAS 1 have moved to IFRS 18 and other IFRS accounting standards unchanged, IFRS 18 introduces 3 new sets of requirements that are aimed at improving the reporting of financial performance. So the first set of key requirements creates structure in the statement of profit or loss by requiring companies to present 2 new defined subtotals. And this will provide a consistent and comprehensive starting point for investors' analysis and help investors compare performance between companies, in particular using the operating profit subtotal, which will now be defined and therefore more comparable. We covered this topic in our first webinar on the 16th of May, and the recording is available to view on our website. The second set of requirements requires companies to disclose information about some non-GAAP or alternative performance measures in a single note to the financial statements, and we call these management-defined performance measures. This will help companies to complement information provided using the new structure of the statement of profit or loss with company-specific information about performance. And they will provide investors with greater transparency about those measures. And we'll be covering these requirements in today's webinar. And the third set of requirements enhances the guidance on grouping of information, and that is also known as aggregation and disaggregation in the financial statements. And this will help ensure that investors receive material information, making financial statements more understandable and useful. And we'll be covering this topic on our third webinar on the 6th of June. So I'll now hand over to Nick and Deborah, who will take us through today's specific topic of management-defined performance measures. Nick, perhaps a good place to start is explaining a little more to our listeners about the current situation with non-GAAP information and the challenges investors told the ISB it poses for them.
Yes, of course. So companies often report their own company-specific measures of performance. Sometimes we know these as alternative performance measures or non-GAAP measures, depending on your jurisdiction. Now, investors told the ISB that they find information about these types of measures useful, but they also expressed some concerns about the information that they receive about them. So, for example, they said it's sometimes difficult to find out about why the measures are used and sometimes how they're calculated. They also said these measures can change from period to period without much explanation. Companies also typically report such measures outside the financial statements, so they're often not subject to audit. So in response to these investor concerns, IFRS 18 introduces disclosure requirements, which will increase the transparency and the discipline in the use of some of these measures by requiring companies to disclose information about them in the financial statements where they will be subject to audit. Now I say some because IFRS 18 defines a subset of these measures, those related to the statement of profit or loss as management defined performance measures or MPMs. The scope of MPMs is a reflection of the focus of this project on the statement of profit or loss. Therefore, measures such as adjusted operating profit, adjusted profit, or an adjusted EBITDA will be included within the scope, but measures such as free cash flows or return on equity will be excluded.
Thanks very much for that explanation, Nick. And Deborah, so that our listeners can better understand which measures are in the scope of the MPM requirements, would you be able to explain the key points about the definition of MPMs?
Sure. So as you can see on the slide, there are 3 key points within the definition of MPMs. So firstly, to anchor these measures to subtotals defined by IFRS accounting standards, the IASB has limited their scope to subtotals of income and expenses. So as Nick just explained, a measure like adjusted operating profit will be in the scope, but a measure like free cash flows will not. Secondly, to provide a link with external reporting, only measures that are included in public communications outside financial statements will meet the definition of an MPM. And finally, to provide users with insight into how management views the company's financial performance, only those measures that reflect that view are in scope.
Thanks very much, Deborah, for that overview of the definition. Just before we look at each of the aspects of the definition in turn, just to remind our listeners that if you would like to ask any questions, please feel free to put them into the chat as we go. And the sooner you put them in, the sooner we're able to address them. So we do encourage you to put any questions that you have into the chat. So, Deborah, on the first of the 3 aspects of the definition of MPMs, you mentioned that only subtotals of income and expenses meet the definition of MPMs. Would a measure such as adjusted revenue be an MPM?
So, no, only subtotals of income and expenses can be an MPM. So, subtotals of only income, such as adjusted revenue, or only expenses cannot be MPMs.
Okay, thanks for that, Deborah. And then how about financial ratios that include a subtotal of income and expenses?
So the financial ratio itself, so something like adjusted return on equity, can't be an MPM, but it's also important to have a look at your numerator or denominator. So for example, your adjusted return on equity, the numerator is probably going to be a subtotal of income and expenses, and that might well be an MPM.
Thanks for that, Deborah. And are there any subtotals of income and expenses that are specifically scoped out of the definition of MPMs? And if so, why are they out of the scope?
Yes, so IFRS 18 specifically scopes out some subtotals of income and expenses from MPMs. So the first example of this is gross profit and similar subtotals such as net interest income. And the second example of this is a subtotal that the IASB has defined called operating profit or loss before depreciation, amortization, and impairments within the scope of IAS 36, which we refer to as OPDI. So these subtotals and a few others are either listed in IFRS 18 or are required to be presented or disclosed by other IFRS accounting standards. And the reason why these are not in scope is because these subtotals are commonly used in financial statements and are already well understood by investors. And therefore, providing the MPM disclosures for such measures would not provide useful information.
Thanks, Deborah. Now let's move on to that second aspect of the definition. And could you tell our listeners a little bit more about the public communications aspect of the definition of MPMs?
Sure. So as I mentioned, the second key part of the definition is that a subtotal meets the definition of an MPM only if a company uses it in public communications outside its financial statements. And this provides a link to other communications companies have with their investors about the company's financial performance, such as management commentary, press releases, or investor presentation. And it really reflects the IASB's objective to bring transparency to measures already communicated publicly by companies and not to create a whole new set of measures. And this seeks to promote consistency in the measures that are reported to investors in the financial statements and in these other communications.
And Deborah, at the exposure draft stage, some of our stakeholders were concerned about public communications being interpreted very broadly, and that would make it difficult for a company, its auditors, and its regulators to identify publicly communicated measures. So, what has the ISB done to address this concern?
Well, to simplify the process, the ISB has scoped some public communications out. So these would include oral statements, transcripts of oral statements, and social media posts. And the reason why is because the ISB expects these forms of communication to contain information about MPMs that are already included in other forms of communication. And these forms of communication are also regarded as the most challenging to monitor, so exempting these from the definition will reduce costs to preparers. So in contrast, as I already mentioned, examples of public communications that would fall in the scope of the definition of MPMs would include your management commentary, press releases, and investor presentations.
Great, thank you for that clarification, Deborah. Now, I'm quite interested in that third part or the last part of the definition that measures must communicate management's view of a company's financial performance. So, can you tell us a little bit more about this part of the definition?
Yes, so this is another area where the ISB sought to come up with a pragmatic approach to reduce the burden on stakeholders and improve consistency of application. And how it works is that it is automatically presumed that a subtotal of income and expenses that otherwise would meet the definition of an MPM communicates to investors management's view of the company's financial performance. However, a company is allowed to rebut this presumption if it has reasonable and supportable information that demonstrates that the subtotal does not communicate to investors management's view, and the company uses the subtotal in its public communications for any reason other than it communicating management's view.
So, Deborah, you mentioned that a company needs to provide some reasonable and supportable information to rebut the presumption. But what are examples of reasonable and supportable information that companies use that would demonstrate that a subtotal doesn't communicate management's view and is included in public communications for another purpose?
Yeah, so examples of reasonable and supportable information include a company communicating the subtotal without provenance and management not using the subtotal internally to assess or monitor the company's financial performance. So just to give an example, if a company includes a statement that the subtotal is provided only in response to investor requests and does not represent management's view, that would indicate that the subtotal lacks prominence. However, if a company uses the subtotal to support management analysis and commentary on the company's financial performance and provides explanations for the reasons for changes in the subtotal from period to period, or if a company provides a comparison of the subtotal to competitors' subtotals or industry benchmarks, that would also indicate performance. Another example is if the subtotal is required to be included in these public communications by law, regulation, or another accounting framework, but does not communicate management's view of performance.
So thanks for taking us through the definition, Deborah. Just to recap, an MPM is a subtotal of income and expenses included in public communications outside financial statements that communicate management's view of a company's financial performance. And before we move on to the disclosure requirements, just as a reminder to our listeners, if you have any questions, please put them in the chat and we look forward to answering them when we get to the end of the presentation. But Nick, can I now go to you for the MPM disclosure requirements and how they can help investors? So would you be able to take us through how the MPM requirements will improve transparency and help investors with their analysis?
Yes, of course. So IFRS 18 will increase transparency around these measures by requiring a number of disclosures to be included in a single note to the financial statements. Now, a key aspect of the disclosures is that each MPM will be required to be reconciled to the most directly comparable subtotal or total defined in IFRS accounting standards or specifically listed in IFRS 18. So, for example, operating profit. This will increase investors' understanding of how MPMs compare with measures required by IFRS accounting standards. The reconciliation will also provide investors with information that will help them to understand how these measures compare with similar measures provided by other companies that may be labeled similarly, and to judge whether they want to make their own adjustments.
Okay, thanks very much for that, Nick. I'm just wondering, would you be able to explain to our listeners what a company will be required to disclose in that reconciliation?
Sure. So there are a couple of specific disclosure requirements, and IFRS 18 will require for each item reconciling the management defined performance measure to the IFRS specified subtotal, the amounts related to each item in the statement of profit or loss, and a description of how those items are calculated. This contributes to providing useful information. So linking the adjusting items in the reconciliation to the line items presented in the statement of profit or loss will help investors to understand the relationship between the MPM and the most directly comparable subtotal or total applying IFRS accounting standards. In addition, a company will be required to disclose the tax effects and the effects of non-controlling interests for each of the reconciling items.
And Nick, I can see that there's several other disclosure requirements on the slide there. So in addition to that reconciliation, what other information will a company be required to disclose about MPMs?
Yeah, so in addition to the reconciliation, companies will be required to disclose explanations of why each MPM is reported and how it's calculated. So for example, a company that provides adjusted operating profit as an MPM might explain that in management's view, this measure provides useful information about the company's financial performance because it's helpful to understanding trends in its operating profitability before the effects of items that management expects to be non-recurring. In explaining how the MPM has been calculated, a company is also required to explain whether the measure has been calculated using accounting policies that may differ from those used in the statement of profit or loss or required permitted by IFRS accounting standards. So for example, if the MPM has been calculated using local regulatory guidance or local GAAP.
And finally, Nick, I noticed that any changes to reported MPMs will need to be explained. So why is this?
Yeah, that's right. Information about how and why MPMs have changed responds directly to investors' concerns. The disclosure requirements will help with trend analysis for MPMs. That's something that is important to investors, and it will contribute to the measures being used with more discipline. Now, both transparency and comparability of a company's MPMs from period to period are also enhanced by providing information about changes to these measures. So the specific requirements are for a company to disclose explanations that enable investors to understand what has changed, the reasons for that change, and to provide restated comparative information to reflect that change unless it's impracticable to do so.
Great, thanks, Nick. So just to recap, companies will be required to disclose in a single note a reconciliation of the MPM back to the IFRS defined subtotal, explanations of why the MPM is reported, how it's calculated, and any changes to the MPM. As always, Nick, these requirements are best demonstrated with some examples. So could you take us through a simple example of what a reconciliation applying the requirements might look like?
Of course. So here we have such an example of what the reconciliation could look like applying IFRS 18. So in the example, we have two MPMs illustrated, an adjusted operating profit, an adjusted profit before continuing, an adjusted profit from continuing operations. So the subtotals are reconciled to the most directly comparable subtotals in IFRS accounting standards. So in this case, operating profit and profit from continuing operations. In the example, the reconciliation is included in a table. Now, that's not a specific requirement, but this format makes it easy to meet the requirement that I mentioned previously to show how each of the adjusting items of impairment losses, restructuring, and gain or loss on disposal of property, plant, and equipment relate to each of the line items in the statement of profit or loss. Now, I also mentioned that companies are required to disclose the tax effect and the effect of non-controlling interests for each of the adjusting line items in the reconciliation. And we can see that in the example shown in the rows below.
So disclosing the tax effect and NCI on each adjusting item will probably be the biggest change for jurisdictions that today have requirements for non-GAAP measures. Deborah, can you take us through these requirements in a bit more detail and explain to our listeners why this information is needed?
Yes, so information on earnings per share is important to investors, and one of the benefits of MPM disclosures is the detailed information investors could use to calculate a related earnings per share figure. And on this basis, IFRS 18 requires a company to disclose separately the amounts attributable to non-controlling interests and income taxes for each reconciling item in the reconciliation. And this is really because it gives investors information needed to calculate an adjusted earnings per share measure based on only the adjustments they want to consider in their analysis.
Now, Deborah, I know that some companies were concerned that the disclosure of the tax effect for each reconciling item might be complex and costly if calculated in accordance with the requirements in IAS 12 on income taxes. So, as this is a new requirement, has the ISB done anything to help alleviate the costs of preparing these disclosures?
Yes, so the ISB did speak to investors about this, and they confirmed that the high-level information about the tax effects of each reconciling item would meet their needs. So based on this, to alleviate the costs of preparing disclosures about the tax effects, IFRS 18 allows a simplified approach for calculating the income tax effect of the reconciling items. And this is based on the tax effects of the underlying transaction at the statutory rate applicable to the transaction in the tax jurisdiction concerned. IFRS 18 also allows a company to use alternative approaches for calculating the tax effects. So a company can calculate the tax effects of reconciling items based on a reasonable pro rata allocation of the current and deferred tax of the company, or by any other method that achieves a more appropriate allocation in the circumstances. And this approach is similar to the approach for determining the income tax effect set out in IAS 12. And specifically allowing the simplified approach and alternative approaches, like I said, really balances the needs of investors and companies by providing investors with a reasonable estimate of the income tax of reconciling items and reducing the cost for companies by simplifying the calculation of those tax effects.
Okay, thanks very much for that explanation, Deborah, on the tax. That is a whirlwind tour through the requirements for management-defined performance measures, and we will come to your questions in a few moments. So if you do have any questions, please put them into the chat, and we'll pick up as many as we can in the remaining time. But before we move to those questions, Nick, could you remind our viewers of the effective date and the published materials for IFRS 18?
Definitely. So as a reminder, to give companies sufficient time to prepare, IFRS 18 is effective for periods beginning on or after the 1st of January 2027, and early application will be permitted. With respect to MPMs, companies will want to think about what measures it expects to use outside its financial statements when it applies IFRS 18, and whether it has the systems in place to gather the information that will be required to be disclosed about these measures, and whether it needs to start communicating any changes to the information currently provided to its investors. It's important to note that IFRS 18 will be applied retrospectively and in interim financial statements. Now, for those interested in finding out more, this slide includes the published materials related to IFRS 18, which are available on our website. These materials include illustrative examples, flowcharts explaining requirements, as well as an effects analysis, which will help our viewers with the transition process.
Thanks very much for that, Nick. And now I'd like to shift to our wonderful questions from the audience that are listening in. Deborah, I'd like to start with a question for you. So why are measures such as free cash flows and return on equity, which are commonly used non-GAAP measures, not in the scope of MPMs?
So the reason why they're not in the scope is because the project's focus was really on the measures of performance in the statement of profit or loss. And this scope was in response to our feedback from investors. So if we were to start thinking about including items from the balance sheet or cash flow statements, that would have required the development of further guidance, which would have affected the timeline for issuing IFRS 18.
And Nick, do you know if the ISB has any plans in the future to introduce sort of requirements for MPMs for balance sheet and cash flow measures?
I think at this stage it'd be too early to say. I think this is a good first step into addressing APMs, non-GAAP measures, and I think there'll be a period of seeing how this beds down before the board decides to go any further within potentially other projects.
That's good to know, Nick. And also, just one more question for you. Is it safe to assume that MPMs must include financial amounts? So non-financial performance indicators are excluded. Is our listeners correct in understanding that point?
Yes, that would be a correct understanding. So as Deborah explained, only subtotals of income and expenses would qualify as management defined performance measures. So anything that would be non-financial would not be included within this scope.
Thanks very much for that, Nick. And Deborah, we get a lot of questions around this. So this is one for you here. What is the difference between management defined performance measures, so MPMs, and alternative performance measures or non-GAAP measures?
So I think it really comes down to scope. So the scope of MPMs is tied to the scope of the project to develop IFRS 18, which, as I mentioned, is focused on improvements in reporting of performance in the statement of profit or loss. And because MPMs are subtotal of income and expenses, they would include measures based on the statement of profit or loss, for example, an adjusted operating profit. And now, generally, in our experience, MPMs would be a narrower set of measures than usually understood to be APMs or non-GAAP. So some measures that are not subtotals of income and expenses will be APMs or non-GAAP, depending on what jurisdiction you're in, but will not be MPMs. What we've also found is that the disclosure requirements in IFRS 18 for MPMs are similar to the regulatory requirements for APMs or non-GAAP measures in many jurisdictions. However, what IFRS 18 does that is different is that we're actually bringing them into the financial statements instead of just the front half of the annual report or in the investor pack. And this would mean that it would fall within the scope of audit, which is currently not the case in most jurisdictions.
Sorry, Deborah.
Yeah, just another thing to point out is that IFRS 18, what is new, and I've already mentioned this, IFRS 18 introduces the requirement to disclose the tax and NCI on each adjusting reconciling item, which is generally not the case for APM disclosures today.
Yeah, thanks for that, Deborah, and sorry for jumping in on you when you were still giving your answer there. Nick, can I just build in on what Deborah has said with another question that we have from our users? So obviously there's various regulatory requirements around APMs today. So there are some concerns from some of our listeners here that it could create confusion to have two types of measures and potential some overlap between these non-GAAP measures. So how are these requirements that are going to work together side by side? Any thoughts around that?
Sure. I mean, I think practice will ultimately develop, but as Deborah explained, the idea was not to create a new set of measures. So there should be, this should be genuinely a subset. I think it's important to remember that not all jurisdictions have the same scope, the same requirements, and in some jurisdictions, there are very few or non-existent requirements in this area. So, what these proposals or what these requirements will do is bring some consistency around the information that investors will get around a specific subset of measures. That as that information is being disclosed or included in other communications outside the financial statements today, the intention is that the information should be available, and in some cases we've gone a little bit further to require some additional transparency. As I say, to make sure that all companies that are reporting these types of measures are reporting the same type of information for investors to get the most transparency.
And then Nick, so obviously today some people are putting these measures into their financial statements already. Will it be permitted to include non-GAAP measures that don't meet the definition of MPMs in the financial statements going forward?
Well, just like the situation today, IFRS 18 doesn't have any specific requirements that permits or prohibits voluntary information. So to the extent these types of measures are voluntary information that companies are providing today, there's nothing that would stop them from continuing to do so within the standard. And likewise, those that are not doing so for various reasons, potentially jurisdictional related, would not be obligated to provide additional voluntary information. Only the information that's required under the new standard.
Thanks for that, Nick. And this is a question we're often asked. So, glad to see that it's in the list of questions that have come through from our listeners. But can companies present MPMs in the statement of profit or loss?
So again, just as we have today, IFRS 18 requires additional subtotals to be presented in the statement of profit or loss. And as we explained in the last webinar on subtotals and categories, this would be the case when it provides a useful structured summary. And we'll just talk a little bit more about this concept in the next webinar. But when this is the case and an entity provides an additional subtotal that's not defined, if it uses that outside of the financial statements and it meets the other elements of the definition of an MPM, it will be a management defined performance measure, and that means you will have a management defined performance measure in the statement of profit or loss. The other consequence of that is that if that is the case, the disclosure requirements will apply and the additional disclosures will still be required in the notes.
Great, thanks for that, Nick. And I have another question here for you, which relates to a topic that I think is very close to your heart, which is the tax, given all the work that you did on this topic. And there's a question around the interaction with IAS 33. So why is the board requiring the tax and NCI for every reconciling item? Why is it just not for those EPS types of measures or for only entities that apply the requirements in IAS 33?
Sure. So who doesn't like tax? The requirements are really in response to investors' requests. There was a lot of discussion around which measure should be included, when tax should be applicable. At the end of the day, as Deborah explained, investors want the ability to be able to really interrogate these measures, to take out certain adjustments and recalculate down to a per share measure. And so that tax and NCI is critical to that. But beyond that, they also appreciated that impact of tax can be quite significant on understanding what that adjustment is. And so in those cases where the tax is significantly different from the average rate, for example, that's information that investors are really interested in finding out, and that's regardless of an EPS type of a calculation going on. So there are a number of reasons going in there, but at the end of the day, it's to give transparency around the adjustments that are being made to the management defined performance measure and give users the information they need to be able to properly analyze them.
Thanks very much for that, Nick. Deborah, I'd like to move on to a couple of questions for you related to public communications. So what I know you explained in the presentation around items that are in and out of scope. So there's been a question from one of our listeners wanting you to clarify what if the measure is only stated verbally but not actually written in a presentation? Would that be an MPM?
So as I already mentioned, we specifically scoped out certain forms of communications from the definition of MPMs, and one of them is oral statements and transcripts of oral statements. So if it's not written in the actual presentation or the investor release or the management commentary, and it's only stated verbally, then it would not meet the definition of an MPM because it's specifically scoped out by IFRS 18.
And Deborah, on a similar note, what if information is provided to only a closed group of investors? Is that going to be a public communication or would it be out of the scope?
So public communications, as I said, include management commentary, press releases, and investor presentations. So on this basis, closed or private communications would probably not be considered public communications. However, we do not expect that presentations to a closed group of investors would contain measures not available publicly, as security regulators generally require financial information to be made available equally to all investors.
Great, thanks for that, Deborah. And Nick, I'd like to move on to segment reporting and the interaction between the requirements in IFRS 8 and IFRS 18. So firstly, how do the disclosures of MPMs interact with the disclosures for segment measures? If you could give us a bit of a helicopter view of how the requirements interact.
Sure. Well, I mean, at a helicopter view level, there are two separate sets of requirements that need to be met separately. Now we know, though, that in some cases, the segment measure of performance for the entity could be a management-defined performance measure if it meets those requirements. So there's some guidance within the standard to say when this is the case, those notes could potentially be combined to include the information together. One of the key concepts around the MPM's disclosures is that the disclosures are in one note. So combining those notes would achieve that and give the information, requiring that the entity be clear about which information relates to MPMs versus that related to the segment reporting. The other possibility would be for the entity to duplicate some of the information that overlaps between the two notes, again, to try and preserve that single note to make it easy for investors to find the information around the management-defined performance measures.
Thanks very much for that, Nick. And so just to clarify, we did have a question from one of our listeners that if the reportable segment disclosed the same metric as the consolidated profit and loss, is it contemplated that the segment measure and the consolidated measure can be presented together? And I think you might like Greg, you just explained to us that yes, you could present them in the same note. Is that correct?
Yeah, so yes, you could present them in the same note. It's not necessarily a requirement to disclose as an MPM all of the breakdowns of the individual segments where that same measure is as a whole. So one of the elements of the definition that we didn't specifically get into within the presentation is that it provides management's view of the financial performance of the entity as a whole. And that wording was specifically designed for this scenario. There's not a need to break down and provide all of that disclosure for each of the individual segments when that's simply a breakdown of the measure as a whole. Now, there will be situations potentially, particularly for entities that have more than one main business activity and so are presenting key operating metrics within the operating profit section of their statement of profit or loss. And if, for example, we had an entity that has a manufacturing business and a bank, and they are presenting measures related to both of these within the financial statements, that measure that relates only to the bank would be the banking activity for the entire entity. And so if that was an individual segment, that particular segment, because it represents the full activities of the entity as a whole, would still be a management-defined performance measure.
Thanks for that, Nick. And it's no surprise to me that given that your love of the tax disclosure requirement, that we've got more and more questions coming through from our listeners on this. But I guess one question I'd like to sort of touch on is the requirement to give the tax for each individual reconciling item. Now, that's not required for each line item in the statement of profit or loss. So could you perhaps explain or sort of recap on the points that we've already raised in the presentation so far around why that tax is required for each individual item? Because we think we have some listeners there who are a bit concerned that it's a lot of effort for preparers. So I think it would be helpful if you could recap on the benefits of that disclosure.
Yeah, I think I like to highlight two pieces there. I think so with the management-defined performance measures, we're starting to move outside of what is defined within IFRS accounting standards. And so there was a need for additional transparency here. Really, this is the key to many of the disclosures, is trying to get more transparency around the measures, and tax is one part of that. So that's sort of a key reasoning behind, is just getting the transparency around how this measure has been adjusted. I think the other point that's worth highlighting is around the fact that there are cost mitigations that Deborah explained within. We know that it can be challenging at times. There are judgmental elements in calculating the tax on an individual item. And so built into the requirements are some options about how that tax is calculated to try and alleviate some of that cost and one of those methods is providing a very specific what we refer to as the simplified method, although that's not the official name within the standard, but it does give a guidance around how the tax could be calculated on a particular item that would meet the requirements, and that's using the statutory rate on the relevant transactions in the relevant jurisdiction. So a very sort of mechanical type of a calculation, which takes away those judgments that make it more complex and therefore more costly. And as Deborah explained, the reasoning that loss of information was acceptable to users was that this calculation still gives them that high level information. Is it taxable? Is it not taxable? Is it taxable at a significantly different rate than what the average rate is for the entity? And so there's this balance of users getting the information that they need to get, again, to get that transparency around the measure, but also an appreciation that in some cases this can be costly, and so some features to try and bring that cost down.
And Nick, just on that note, so obviously the board considered how to reduce the cost by these simplified approaches. And there's a question a bit more detailed. What if you've got transactions in multiple jurisdictions? How would an entity go about approaching the way to calculate the tax effect on the adjustments?
So again, if we're talking specifically about the simplified method that I explained, it would require considering what the statutory rate is for each of those individual jurisdictions. So each transaction in that jurisdiction at that transactional rate added together. So there is some work to be done. It's appreciated that this is more than simply the average rate or not doing the calculation at all, but not going as far as having to apply judgments to allocate deferred tax, for example.
And Nick, just to give a little bit of spotlight, because obviously tax and NCI are a set, so we don't just want the tax and we don't just want the NCI. We've talked a lot about the tax because I know it's one of your favorite topics, but could you also talk to us a little bit about why the NCI is required?
Sure. I think we talk a lot about the tax, not because it's necessarily my favorite topic, but because it's something that is new and something that investors really were after. They were after also the NCI, and that goes back to the reasoning that Deborah explained is that's needed to do the per share calculation. If for example, an investor said, I accept this NPM, but I don't think that this particular adjustment makes sense in this context. And so I'm going to recalculate this by taking that out. And to do that and to understand the per share impact of that, it would need to know not just the tax, but also the NCI. Now this, as I say, tax is the one that gets the highlight. And that's generally because we haven't heard a lot of feedback around NCI being difficult. Entities are really best placed to understand the structure of the entity and where those impacts will lie.
Thanks for that, Nick. And just a bit of a switch now away from the tax, but Deborah, question for you here. Would additional subtotals similar to gross profit be classified as management defined performance measures?
No. So as I explained earlier in the presentation, additional subtotals similar to gross profit, such as net interest income, are listed in IFRS 18 and therefore would not fall within the definition of MPMs. They are explicitly excluded from the scope of MPMs.
Thanks for that, Deborah. And now we've had a couple of questions come through on EBITDA. So will EBITDA be an MPM?
So that really depends on the composition of your EBITDA measure. So what the IASB has done they have defined a measure called OPDI, or operating profit before depreciation, amortization, and impairments within the scope of IAS 36. So if your EBITDA measure equals that OPDI measure, even if you call it EBITDA, it's still not going to be an MPM because it's specifically excluded from the scope of MPMs. However, if your EBITDA measure includes some other adjustments that is not within operating profit before depreciation, amortization, and impairments within the scope of IAS 36, then that would be an MPM.
Thanks for that, Deborah. And Nick, a question here for you around, so why is the IASB not proposing any restrictions on how to calculate MPMs? Bit of concerns around MPMs could be misleading if the board didn't introduce any restrictions, and even concerns from listeners that by the IASB introducing these requirements, it's actually legitimizing non-GAAP measures. So could you possibly talk to these points that have been raised by our listeners?
Sure. So I think it's important to remember that non-GAAP measures and APMs are used in some jurisdictions quite extensively today. And so the idea is really to bring a spotlight on those measures and bring transparency, and as I say, bring that transparency across entities that present them. So really, this is the sort of the key the concept here, and so that rather than trying to ban or prohibit certain measures, something that the board felt would really go against the idea that it presents management's view. And if we remember, that's one of the things that investors really appreciated about the non-GAAP information that's out there today, is that it shows or gives information about how management views the performance of the entity. So if restrictions were placed on that, it really doesn't give them that information that they're after. So that's sort of one of the reasons. Then those disclosure requirements giving that transparency helps to alleviate some of the concerns around them being misleading. The more transparent those measures are, the easier it is to understand them, the less likely to be misleading. I think also being included within the financial statements themselves means there's additional overall requirements that are, or general requirements within the financial statements, such as faithful representation. There's new guidance around labeling that helps to make sure that those measures are labeled and explained appropriately to make sure that users are not being misled by what those measures are.
Nick, so thanks very much for that explanation. Now, it's a slightly different topic, but something that we are occasionally asked about is, why didn't the ISB consider allowing a reconciliation to be included in other financial documents, such as MD&A, with a cross-reference to these disclosures that are in the financial statements? So IFRS 7, for example, allows cross-referencing for certain risk management disclosures. And so some people would think that an approach that allows cross-referencing and having those disclosures outside the financial statements, but bringing them in through a cross-reference, would be easier for users to understand, as the reconciliations would all be in one place rather than separated. So just wondering if you could provide some color to our users around the board's position on cross-referencing.
Sure. So IFRS 18 is actually silent about cross-referencing. Now, there are some standards that provide specific cross-references, and the board did debate whether a specific reference to cross-referencing should be included within this standard. However, one of the key concepts around management-defined performance measures is that they are in one place. And now, while for some entities, this may be the case that all of their MPMs are in one communication, for example. That's not the case for all entities, and this was one of the key pieces of feedback from investors, that they have difficulty sometimes pulling together all of the information around non-GAAP measures as they're known today, because this information can be in different places for different entities and sometimes distributed across many different places. So one of the key concepts was to bring that all together and have it in a single place where investors know where to look to find this information. And so having cross-referencing as a possibility contributes to that state of diversity and where different entities will disclose this information. So the board decided not to include a specific permission, if you will, to cross-reference. Given that that it is silence about that, we expect that the interpretation of that silence will potentially vary in different jurisdictions.
Great, thanks for that clarification, Nick, around cross-referencing. Now, Deborah, a question for you is, are MPMs measures of management's performance? You're on mute, Deborah.
Sorry about that. So they are not measures of management's performance. They are measures of the company's performance in the view of management. So even though they might be used for determining management compensation, their main purpose is to communicate management's view of the company's performance, and they wouldn't be the performance of management themselves.
Thanks very much for that, Deborah. Sorry, I'm just getting to the next question here, Nick. How are MPM requirements different from existing regulated definitions or non-GAAP measures?
So there are probably a few key differences from what we know. As I mentioned before, there are different jurisdictions with different regulations, and so there may be differences depending where a particular listener is. But in general, the scope of being subtotals of income and expenses is much narrower than most regulatory definitions of what APMs or non-GAAP guidance is. And so we expect there to continue to be those regulations and for there to be other types of non-GAAP measures, for example, based on balance sheet or cash flow measures that will be included outside the financial statements and will stay in that realm and subject to regulatory regimes. So that scope is one element. Also, in relation to the scope, because we're based on public communications as part of the definition, that leads to a slightly different scope in some cases, where regulation is usually based around specific documents that are within the scope of whatever that particular regulation is.
And sorry, Nick, keep going.
No, you'd also asked about the disclosure requirements, and I was just going to say, generally, we've taken inspiration in the development of those disclosure requirements from regulatory regimes. And so for the most part, the disclosures will be very similar to what are required under APMs or non-cap guidance today. However, there are some differences where there are specific additional requirements, the most notable being, of course, the tax and NCI, which we've talked quite a bit about today.
And Nick, sorry, since you're on a roll there, what must a company disclose for a change in an MPM?
Sure. So as I explained earlier, when an entity changes its MPM, so if it decides not to use an MPM anymore, or if it introduces a new one, or changes how one is calculated, it needs to explain what that change has been, why it has made that change, and then also to restate the comparative information unless it's impracticable to do so.
Okay, so Deborah, can I move on to a question for you here? And there's two parts to it. So are companies required to have MPMs, and can companies have more than one MPM?
Yeah, so I'll answer your first question first. So are companies required to have MPMs? The answer is no. Companies are not required to have MPMs. But if they do use a measure that meets the definition of MPMs in its public communications, then it would be required to provide the relevant disclosures. So we're not forcing companies to provide measures in their public communications. If they don't want to do that, that's fine. But if they do, they will have to provide the disclosures. And then to answer your second question, if companies can have more than one MPM, the ISB has not limited the number of MPMs a company can have. So however many disclosures, subtotals of income and expenses in your public communications that meet the definition of an MPM, that's how many MPMs you would have.
Great, thanks for that, Deborah. And Nick, as a former auditor, I think this is the perfect question for you. Will MPMs be audited? And if so, how will they be audited?
So we expect MPMs will be audited, given they will be included within the required note disclosures within the financial statements. We expect that they will be audited in a similar way to the way auditors will approach the IFRS 8 disclosures today, which can include similar types of measures.
Okay, thank you very much for that, Nick. I see that we're slowly running out of time here. So Deborah, can I go to you with our final question here around digital reporting and what's the impact on digital reporting?
Yeah, so the presentation and disclosure requirements introduced by IFRS 18 are going to be reflected in our IFRS accounting taxonomy. And what the ISB is currently doing is consulting on the proposed update to the IFRS accounting taxonomy. So if you have any views or thoughts on that, we would encourage you to submit a comment letter, and the information on that should be on our website. In terms of how it would help investors use digital financial statements, because IFRS 18 enhances the structure of the statement of profit or loss and improves comparability of information about companies' financial performance, the proposed update to the IFRS taxonomy would extend these benefits to digital reporting, allowing investors and other users of digital financial statements to efficiently search, extract, and compare statements prepared in accordance with IFRS 18. And finally, just to mention that the ISB is conducting a fieldwork exercise to test the proposed modelling during the public consultation period in June, July, and August. So we would appreciate your input and thoughts on that as well.
Nick, sorry, there's been a couple of late questions come in, and we do have a couple of minutes to pick them up. So I'm just wondering, could you tell us how regulators have responded to the management defined performance measure disclosures?
Sure. So, I mean, I think as with all stakeholders, we've been on a bit of a journey with management defined performance measures. And I think there was a lot of hesitation, certainly early on. One thing after the proposals for MPMs in the exposure draft went out, we got a lot of comments back, including from regulators that really supported the idea of what we were trying to achieve in terms of getting transparency and discipline. We're very much on the same page as regulators in that objective. Now, in terms of the specific disclosure requirements, there are some differences, and we've had many discussions with regulators along this journey to try and get as close as possible to make sure that their requirements are being met by meeting our requirements. We've talked about the fact that there are a few differences, and we've tried to work very closely with regulators to get the wording right to make sure that the regulations that they have in their various jurisdictions will still continue to be able to be applied in similar ways to the way they are today. So I think for the most part, the feedback as it's come along that journey has improved, and regulators are generally quite supportive of having management defined performance measures. As I say, those our objectives are quite aligned in what we're trying to achieve around transparency and discipline. Practice will obviously evolve, and I can't speak on their behalf, but we've certainly heard positive things as this has developed.
And Deborah, could I get you to go back one slide? And just as we're slowly coming out of time, I will pick up one question. It's not related to MPMs, but just more broadly to IFRS 18 and the relationship with IS1. So as you can see on the top right-hand corner of this slide, we have IFRS 18 on one page, and in that we highlight the requirements that have been carried forward from IS1 to IFRS 18 or other IFRS accounting standards unchanged, and also the new requirements introduced by IFRS 18. And a question we're quite often answered is why did the board replace IS1 with IFRS 18 rather than calling it amendments to IS1. And the board thought at the ED stage in particular that the changes introduced by IFRS 18 were quite pervasive, and calling them as amendments to IS1 would not really reflect the substance of those requirements. So it made the decision to then replace IS1 with IFRS 18. To help you all on your implementation journey with IFRS 18, we produced a suite of documents, which you can see showing on the slide. I'd just like to highlight that in the back of the illustrative examples, we have included flowcharts to help you navigate the requirements, and they are referred to as supporting materials. So an example of one of the supporting materials that we have provided is a decision tree to determine whether or not you have management defined performance measures and whether they need to be disclosed applying the requirements. We also have effects analysis, which will help many of you on your implementation journey, highlights based on a sample of 100 entities where we think the most changes will be required by IFRS 18. We also have a high-level project summary and then feedback statement on all the wonderful feedback that you gave us from the exposure draft. So all of these materials are available on our website, and any new information that we add to the website, including the recording of today's webinar, will be available on our implementation support page. And if we flip to the last slide, Deborah, just to note that we do have a questionnaire there. If you would like to provide us with any feedback, you can use the QR code on the slide to provide us with feedback. We thank you very much for listening today, and also thank you very much to Nick and Deborah and our wonderful AV and support staff who have been supporting this webinar. And a reminder that we have our third webinar on grouping of information or aggregation and disaggregation next week on the 6th of June. So we look forward to connecting with you again next week. And thank you very much for joining today and for all of your wonderful questions. It's absolutely fantastic for us to receive your questions and see what you're dealing with on your implementation journey. So thank you very much for listening, and see you all next week.